Joined by Gagan Banga of Indiabulls Housing Finance. He's a Vice Chairman, Managing Director and Chief Executive Officer. Thank you so much, Mr. Banga, for taking the time. Could you walk us through the performance for the quarter? What led to that pressure on profitability?
Yeah, so we started the transformation of the business from a business which relied a fair bit for its profitability on the wholesale book. And around 8 quarters ago, we started the transformation, which had 3 parts to it. The first part was significant deleveraging, both by reduction of the book as well as by raise of fresh capital, and making sure that the balance sheet was fortified, which required us to also invest in significant provisions. Having done all of that, the second part of the journey started, which was a consolidation of the wholesale book, which obviously has an implication in the short term on profitability. But in the medium to long term, we land up building a far more granular retail focused book with minimal leverage. So the leverage is now down to only about 3 times. The retail disbursals are growing. And as is evident from the last 4 quarters now, quarter on quarter, the profitability is also trending up. So the way we are looking at our business is less around what was happening an year or 2 prior, but on a quarterly basis, how we are improving. The focus is on unit economics. The focus is on growing the retail disbursals.
Right. Gagan, also tell us a little bit about how your retail book is shaping up and whether or not you are taking any more opportunities on your wholesale book, or is that going to be a bit of a degrowth?
Just to clarify, it's not as if we are new entrants into the retail space. There was a mix that we were pursuing earlier, which had a fair bit of wholesale lending as well in it. For the last 2 years, the side of pumping capital into projects which are already mortgaged to us and which are reliant on us for financial closure, we're not really undertaking any new opportunities in wholesale lending. We are focused on degrowing that book. And the goal that we've set for fiscal 22 is to degrow that book by about 33% versus fiscal 21. What we are doing on the retail side is an extension of what we've been doing for the last 15 years. We had to, as part of the transformation, significantly reduce our disbursements, especially given the liquidity crisis around the NBFC space. Having sorted out our resource base, we have started ramping up disbursals. We've also transformed the model such that in the medium to long term, we don't see volatility around disbursals, book profitability, etc., which NBFCs tend to witness every 3 to 5 years whenever there is a liquidity cycle shift or an interest rate cycle shift. So we've moved on to an asset light model. It took us close to a year to year and a half to set up the relationships. We were very focused on making sure that each relationship has a strategic angle to it and it is not opportunistic, thereby also long-term reducing the volatility. Having done that now, just in the month of September, from just co-lending and not the whole disbursal, just co-lending, we were able to disburse as much as 325 crores.
And the second quarter, has demand translated into disbursements? I would love to know about that because, sometimes there is a disconnect there. Where do you see the bulk of the demand also coming from?
Yeah, as I mentioned, co-lending, we are targeting 1,000 crores in the current quarter and 1,500 crores via co-lending in the next quarter. Disbursals are trending quarter 1 to quarter 2, we were up close to about 30%, and quarter 2 to quarter 3, it seems that we will be up another about 30%. So that is how the number is looking. Obviously, the macro is clearly helping. What is also helping is that back in the day, we used to do as much as 3,000 crores of disbursals. We did not undo the core structure, so the capacity is there. But we are niche players. We are not mass market players. So within the niche segments that we operate in, there is a fair bit of opportunity to grow, to lend to the self-employed, to lend in tier 3 and 4 cities. And that is the area of focus. So quarter on quarter, in terms of retail disbursals, I would imagine that at least for the next 3 to 4 quarters, we can look at a 25 to 30% sort of a growth in retail disbursals.
Understood. Mr. Banga, I just want to get your view on this. A lot of players in the real estate space, both developers as well as financiers like yourself, are quite positive on the trends that they're witnessing currently, in that a lot of people seem to be going out shopping for houses. The question is, do you see a multi-year opportunity for yourself and a multi-year bull run for real estate companies and real estate financiers?
So here I would like to comment on two parts. One, as far as the underlying macro is concerned, which for housing finance companies is the real estate segment. One believes that, we've come through a long down cycle, which started back in 2012-13 on the residential side. It's turned after about 7-8 years. And if we go back in time and look at these real estate cycles, they tend to be longish. So one is optimistic that the next 8 to 10 years for the residential real estate should be very, very positive, especially given the fact that the GDP is also expected to touch a $5 trillion mark over the next few years. And the overall India growth story seems to only be getting stronger by the passing day. As far as HFCs, or I would extend that now to even NBFCs, there are a few key stakeholders. There is the regulator. I think the regulator has done an excellent job in overhauling the overall regulatory framework for NBFCs, including HFCs. Most of, as far as the policy making on the regulatory framework side is concerned, is now over, and now it is for NBFCs to adopt and subsequently adapt their operations. I think most are doing quite a good job at that.
Right. Gagan, as I see it, your asset quality has improved in the second quarter. Help us understand what trends do you foresee going forward, and whether or not you can improve your asset quality going forward.
So the company has already invested a fair amount in provisions. We carry close to about 5% of our overall book as provisions, which is close to about 4x of regulatory requirements. Specific stage 3 provisions are in the ballpark of 45%. So whichever way that you look at provisions, especially given the background of our very high consolidated capital adequacy of over 31%, I think we are both from a capital as well as a provision perspective in a very good position. That said, I still believe that the entire impact of COVID would continue to play through, which is why we've given a guidance that the gross NPL in the near term should be in a range of 2.5 to 3.5%. We are currently at about 2.7%. And the credit costs for the full year should be in the range of 100 to 125 basis points. Last year, we did 110 basis points, so pretty much in line with what we did last year. So that's how we're looking at overall credit quality. So it is a picture of stability. Fortunately, the legal system is also coming back into action. From virtual courts, now we have physical hearings. So there is a lot of activity which is happening on the recovery side, which makes me believe that we are being conservative in these numbers. But given the various uncertainties, one would continue to prefer to be conservative in the near term.
So Banga, I'm going to make this my final question. So when you have this big comeback of the property market for the first time since Lehman Brothers, what's the response that you've seen to the new launches? Are you expanding to new geographies? We're just finishing an interview with Prestige, for example, which is getting out of its comfort zone of South India and entering Mumbai and Noida.
So we are more focused on getting into the smaller cities, cities which are significantly underpenetrated. And we've done 18 new locations in the first half. For the full year, we're looking at doing around 50 new locations covering tier 4 and 5 cities. And that would remain the area of emphasis as far as the physical distribution is concerned. That said, there is a lot of emphasis on also the digital distribution, which facilitates both internal processing as well as the customer user interface. And that would continue to allow us to reach deeper, as well as the entire distribution cost to continue to trend down. So in terms of overall focus, the overall focus would be to consolidate in the bigger cities as far as physical distribution is concerned, and expand in the underpenetrated tier 4 and 5 locations of India.
Okay, Gagan, we're going to leave it at that. It's always a pleasure talking to you. Thanks so much for joining us here on ET Now to take us through the fine print and, of course, the